Everyone has to remember what the Fed's job is. It's not their dual mandate. The dual mandate is just verbal diarrhea for the masses. What it really is to make the Treasury look solvent. So, and you can see it in their policy right now, where if we have 5 or 6 or 7% inflation, right? Well, shouldn't they be jacking up the 1 to 5 year yield to like 5 or 6% or something like that? They're never going to do that. And the reason why they're not going to do that is because most of the Treasury, meaning the debt of the government, US government, is financed between 1 and 4 years. And if they hike that up to, let's say, 4.5%, over the next 3-year period, the current debt is yielding at about 2.5% or so, and it's actually a bit less now because yields have been lower. And the financing of those coupons will go up to 4.5% or something like that on the 1 to 5 year yield curve. Well, so what? What does that matter? Well, it's just like everybody with their teaser rate and their credit cards. The rate goes up for the government. And the government right now is spending about 15% of tax revenue to pay those coupons. If that coupon doubles or goes up by 70% from 250 to 450, well, all of a sudden the government's going to have to dole out 30% of tax revenue to pay the coupon. Mm-hmm. And when you back out GDP for the US, all the growth in GDP for about the past decade has been due to government largesse. So we turn into the death doom loop where the government can't spend because they owe so much in coupons. So, and we can't let that happen because we run into the death doom loop where we have inflation and negative GDP growth and essentially the potential for a run on the dollar in some regard. And so for that reason, I believe it's not about the election, in my view, in November, what our good friend Kyle Bass said. I actually think it's about finding a spot on the yield curve where the Treasury can finance at a low yield. And that will be an inverted yield curve. And they're going to tank the economy so that they can finance the federal government at a low yield, so they don't run into the paying out 30% of their tax revenue as coupons. Because, I mean, think about that. That's our entire military budget or Social Security or Medicare. And we can't come up short on that. So what'll happen if that happens, we'll have to borrow more to pay that while yields are going up. And that puts you into that kind of doom loop. And so they have to keep yields down somewhere on that curve or else it's certain doom. And they can do that by tanking the economy. And I think that is the plan. And so forget what the Fed says, watch what they do, and scratch your head and say, what are they really doing? And I think it starts becoming much clearer then.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.